Kellanova, formerly known as Kellogg Company, successfully completing the separation of its North American cereal business today. Company's now going to focus on snack, international cereal, noodles, as well as North American frozen foods. Steve Cahillane joins us here on set after ringing the opening bell. Talk through the spinoff. Steve, welcome, which we've talked about for a long time. Finally here.
Yeah, it's finally here. We're very excited to ring the bell this morning. It's been 18 months in the making, and Kellanova, is off to the races today.
Do you want to remind viewers about the motivation and the thinking behind this from the get-go?
Yeah, so, we felt that the cereal business could really flourish by being an independent company focused on North American cereal. And what gets unlocked with Kellanova today is the fact that 80% of our portfolio is now snacking in international businesses. Very high growth, growing like a snacking powerhouse that it is, driven by 5 of our largest brands: Pringles, Rice Krispies Treats, Cheez-It, Pop-Tarts, Eggo Waffle, all high growth, very differentiated, very advantaged brands. And we think the market will appreciate the underlying strength of that business more as Kellanova than they have historically.
How do you compensate those, Steve, for the lack of scale? Because that's what it has been always about in these industries, getting shelf space, scale on manufacturing and on distribution. And now that you're going to be leaner, it's better, I guess, for innovation to be more nimble, but the scale is a negative, isn't it?
Yes, Sarah, we still have tremendous scale. So you're talking about a $13 billion business, $2.7 billion we're divesting, obviously, or spinning off. But in North America, where we're spinning it off, we are still a very much scale player. And we're growing faster than most retail is. So we provide a tailwind of growth. And again, Pringles, Rice Krispies Treats, Pop-Tarts, these are great brands. So we don't lose any scale or scale advantage with our customers.
They're great brands, but are they growing market share, Steve?
Well, you really have to look at a 2 or 3 year trend because there's been so much noise in the system, so much pricing that we've taken. So over that time period, yes, they're all growing, and they're growing share, and they're growing nicely.
Steve, given the conversation we just had before you came on, I do have to ask you, are some of these new drugs a concern at all in terms of people's willingness to eat a lot of Pringles or Pop-Tarts? It won't affect me, I can tell you right now.
But you're not on them.
Well, I like Pop-Tarts.
But you're not on the obesity.
I am not on the obesity.
The drug will literally not work on David. That's what he's saying.
Exactly. It won't work on me. No. In all seriousness, does it become a concern in terms of consumption?
Well, first let me say, we are not complacent about anything. We are being asked the questions, heard you guys talking about it, but it is way too early and very premature to talk about. We don't know the penetration that these drugs will get. We don't know longitudinally what happens with consumer behavior. We know what people are saying they're doing in terms of changing their diets and so forth. But it's just way too early to tell. We'll watch it. We'll understand exactly who's going to be on it. But then, very importantly, understanding what, if anything, behaviorally changes over a period of time.
Yeah.
And it's just far too early to forecast this as a headwind, in our opinion.
What about, you mentioned pricing. When do you expect volume and price to cross paths again?
Yeah, we think it's starting now, really, and into next year. So if you think about the last 18 to 24 months, we've taken 30% pricing. That's like 10 to 12 years of pricing in a very short period of time. Of course, it's going to affect volume, and the elasticities are returning. But as we get to 2024, our supply chain is now back to pre-COVID strengths and even stronger, so we can make our customers' orders at a fill rate that's very, very high. We can bring innovation back to the fold. We've been innovation suppressed because of the pandemic, because of the supply chain bottlenecks and shortages. And, pricing doesn't have to be, continue to go up. We're looking at a more benign cost inflation environment into next year. So all those things really work to help us think about volume in a more constructive fashion.
And to the degree you were discounting now, is it getting the reaction function from consumers like you expect?
It's starting to, but we're not back to the levels of frequency and promotion that we were pre-pandemic. We're getting there. So back to school was a little bit more familiar to our consumers, more like pre-pandemic. And as we get into NFL and you get to think about Super Bowl promotions, I think that going into next year, you're going to see a very exciting retail environment, the likes of which we haven't really seen since COVID.
Really? Because so the other concern around packaged food right now, besides the fact that you don't have the same kind of pricing power, is that we're starting to see consumers trade down. That consumers are pinched, especially at the low income, and it's coming amid even more headwinds, like the student loan payment reduction. Are you seeing any of that?
There is no question that consumers are feeling the strain. We are not seeing trade down. We're not seeing growth of private label in any of our categories. And so, we work very hard to earn the right to be in that shopper's basket. So we have to think about affordability. We have to think about package sizes. We have to think about where consumers are in their journey from a monthly standpoint. At the beginning of the month, times are a little bit easier. At the end of the month, times are very, very tough.
Yeah.
And there's still a lot of headwinds for the consumer, but the U.S. consumer and indeed the international consumer have proven to be very, very resilient through what otherwise would be a really challenging set of circumstances.
So Steve, you've created this pure play now, but I wonder, do you expect to grow it simply organically, or is it possible, given you do have a currency, there may be some brands out there that fit into the portfolio? How does M&A, if at all, figure into your strategy?
Yeah, so our balance sheet is very, very strong right now. Our leverage ratios are down. We have dry powder. We can definitely make acquisitions. We will measure that against the organic opportunities we have in front of us, which are fantastic. We're only starting to expand Cheez-It outside the United States, for example. So we've got tremendous organic opportunities. If we see something inorganic that can add share owner value, we'll be a disciplined buyer.
Finally, Kellanova is Kellogg and Nova, meaning new. Is that fair?
That's right. That's right. We wanted to keep the iconic K. We wanted to keep the beginning. So when you see Kellanova, we want people to think, I recognize that. What is that? And it starts the conversation around who we are and who we aim to be.
I remember when we spoke, when you first announced the split, and the big concern was keeping the Kellogg name. You guys did that, and the cereal name as well. Keeping Kellogg, true to the history.
We're thrilled. One of the biggest things when we announced this to our employee base was, I'm so proud to say I work for Kellogg. Please don't take that away from me. And, so our employee base was very excited when we announced Kellanova. They're very excited about the future. And, it starts today.
And you've maintained the dividend. I know that was a key throughout, correct?
Yeah, we maintain the dividend whole between the two companies.
Yes.
And so the vast majority of that dividend goes with Kellanova. And so, it's important to our stock. It's important to our share owners. So, yes, it remains completely whole.